Trideep Bhattacharya is with us. He's CIO-Equities at Edelweiss AMC. Trideep, good to have you with us here. Thank you very much. Just a word on, I mean, if you have any thoughts on the flow picture. So 14,000 crores total. Eight out of that is basically, or rather 6 out of that is NFOs, and then there is 12,000 which is SIPs. The discretionary number is kind of dwindled into deep in the negative actually for the last many months now. Any thoughts?
I think basically in a smaller period when you have a cluster of NFOs come through, usually you see this sort of a picture. But overall, if you look at the rising trend within SIPs and also the fact that the flows have continued to be on the positive, I think goes on to show the equity appetite for in general within India, which doesn't seem to be waning away, which is a good sign, particularly in the context of so much of global noise that we hear. I think this is a good place to be, probably kind of, keeping our markets afloat overall. But yes, I mean, incrementally what we are seeing, the discretionary part moving from lump sum to more like SIP or STP kind of investments. So the lump sum part of the investment has kind of, is still missing. And I think that number will swing around once you see the lump sum part also coming back.
Trideep, afternoon. What's the call on cement now? The competition appears to be hotting up even more. There are talks about how Adani Group is likely to bid for Jaiprakash's cement unit. What's the view now on the individual cement names, the sector as a whole, the competition dynamics, the supply demand?
So I think two parts to it, the structural part and the cyclical part. The structural part is that you have a new name entering into the industry. The good part of this is that there is no incremental new capacity being added, in the sense that there is no separate non-cement capacity being added. It's basically capacity changing hands. So to that extent, a new player coming into the industry is not that much of a risk as what it initially turned out to be. How aggressive Adani Group turns out to be will only be known over the next couple of years, as capacity on the cement side only takes a good bit of time to come through. But immediately, too much of capacity coming into the sector is not an issue. It's more capacity changing hands, and what they do with that capacity is what it is. So structural side, near term, okay, over time worth evaluating. From a cyclical standpoint, we are gradually entering into the season from the lean season, which will probably be reflective in the quarter that they will report, to basically more the demand season, the in season for cement, where generally cement demand tends to look up. So from that point of view, directionally, I would probably be a little more positive than I was with regards to cement as we are entering into the busy season. And given that we think that the real estate sector and the construction side of the economy are likely to do better, cement will also probably see some good days in the sun.
Hi Trideep, good afternoon. Trideep, I think for the last 1 year or so, you've been underweight IT, if I remember correctly. What's your stance? I mean, for 2022, it hasn't belonged to that space. This evening, we'll get numbers trickling in. Besides the numbers, the commentary will be important. But what's your stance out here? Still, there is a further correction before you get interested in the space?
So I think overall, there are grades of being underweight, right? So we had maximum underweight in and around September, October last time. That underweight position has probably narrowed. But if you ask me, even today, I would continue to stay underweight. And the reason why it is that way is because while the multiples have corrected, and 2023 or FY23 earnings have sort of, seen the hammer, FY24 is where the key uncertainty really lies. And unfortunately, none of these companies are going to talk about it in the upcoming result season in that order. I think the first time we'll probably hear is maybe in the next calendar year. So I think we're going to probably live with a bit of uncertainty, and from that point of view, if the stock prices would react to the near-term data points, and the September quarter, from what I hear, is just about fine, which is what you are seeing in the share prices. But I think the key element of debate is still unanswered with regards to the fact that in the light of global recession or recessionary conditions, how does global demand stack up for Indian IT services companies in FY24? I would say the jury is still out on that one.
What is the analyst community? I mean, how is it broadly? And if you speak to 10 or 15 analysts, I mean, are they now coming around to the fact that maybe things are based out there, or?
I think it's very, very divided. So you've got a JP Morgan, Nirmal Bang, very bearish, but on the other hand, Macquarie is still very bullish on the prospects of Indian IT, and they believe tech spending is going to be the last to get cut. I think it all depends on how deep the recession turns out to be. So if it's a very mild, moderate one, tech budgets could stay intact. And as Trideep pointed out, I think the earliest clarity we will get is in January. That's when the budgets typically get set. So in Q3, we will have a clarity of what the budgets are. Because right now, at least, despite a volatile macro environment, the demand is resilient. And this quarter's numbers, next quarter's X of the furloughs will look good because it's a function of the deals which you've struck earlier, which you won 2 years, 1 year ago. You're executing it, right? So the numbers may not paint the picture. But, the IT companies are generally very cautious. They refuse to give you any forward-looking statement. So as Trideep pointed out, I think that uncertainty about FY24 will linger till, January. And
I thought that's the one sector which gives you maximum disclosure and guidance. Wipro, for example, puts out that 1 quarter
quarterly
guidance.
Infi used to, then they stop. But so now you've got an annual guidance from Infi, HCL, and Wipro in terms of quarterly.
Yeah.
But they're not going to tell you FY24. They're not going to come out and say.
But you don't know what you don't know, right? I mean, they don't know. So how can we expect them to kind of crystal gaze in that sense? And that's the problem. I mean, right now things are looking good in the US, which is the largest geography for most IT companies, and so numbers should be coming in good, and commentary should be quite okay as well. So will this be a trading bounce or something else? We'll see. Anyway, Trideep, what else are you focused on right now? I mean, lots moving around, and when you have these kind of very volatile markets, you do get big dips, and in individual stocks you may be interested in only to see recoveries. Are you seeing any opportunities like that with the volatility?
So I'll tell you, to be honest, yes, the volatility sort of keeps us on the tenterhooks. But what we continue to stay focused on is the high frequency indicators or the on the ground demand data. And I think that's what we have really on the face of global slowdown. The on the ground demand data still continues to be strong. Until the time there will continue to be opportunities. So the areas that we're seeing stronger demand, for instance, the festive demand in terms of the online sales continues to be fairly robust. I think the urban demand has held up quite well. The high frequency indicators show that the capex cycle is still very much on track. And I think the incremental data points on real estate side point towards in the positive direction. On the not so positive direction, of course, we have data points emanating out of rural India yet to sort of make a comeback. And of course, the global focused businesses have their own issues. So I think when I look at all of this, basically, and think from a portfolio construction point of view, I still think that domestic cyclicals are the place to be, and global focused businesses will probably have a bit of runway in front of them before we sort of, come to terms with how demand might meet supply and then take a call accordingly.
All right, Trideep, final question from my end before we let you go. Everyone's a buzz that the auto space is seeing a recovery and we're likely to see growth for the next couple of years that we haven't seen in the last few years. What's your view on the space? I recall that you were reasonably positive on the CV space. I think companies that had some EV exposure as well. Are you holding on to that stance? Because that's been a relatively outperforming sector. Go ahead.
Yep, I think when we spoke last, we talked about the chip supplies and how cyclically things might look better as commodities ease, and we are actually kind of getting into that part of the year when those things will play out. So we were very positive at that point in time. The valuations were truly in our favor. At the moment, we'll probably be a little more balanced than what we were then, but continue to remain positive overall on the auto space. But we are now more focused on specific pockets within autos where we think there could be more company-specific angles to the story rather than just about the sectoral tailwind, which is, I think, now consensus view.
Trideep, do stay on. We need to slip into a very short break. But on the other side, we'll also get you a check on what dealing rooms are saying in our segment D Street Chatter. And we also tell you what you can buy today that you can sell tomorrow. Calls coming in from our technical experts.